You're welcome back. In this video, we will look at the general features of financial statements. The following are the general features of financial statements. 1. Fair presentation and compliance with IFRS. 2. Going concern. We have accrual basis of accounting. We have materiality and aggregation. Offsetting. We have frequency of reporting, we have comparative information, and lastly is consistency of presentation. So firstly, let's look at fair presentation and compliance with IFRS. An entity achieves a fair presentation by compliance with applicable IFRS. A fair presentation also requires an entity to select and apply accounting policies in accordance with IAS 8. We'll still get to IAS 8 very soon. Also, to present information, including accounting policies, in a manner that provides relevant, reliable, comparable, and understandable information. And lastly, to provide additional disclosures when compliance with a specific requirement in IFRS is insufficient to enable users to understand the impact of particular transactions, other events, and conditions on the entity's financial position and financial performance. Another general feature is going concern. When preparing financial statements, the management shall make an assessment of an entity's ability to continue as a going concern. In assessing whether the going concern assumption is appropriate, the management shall take into consideration all available information about the future of the reporting entity. When an entity has a history of profitable operation and ready access to financial resources, the entity may reach a conclusion that the going concern assumption is appropriate without detailed analysis. When management is aware, in making its assessment of material uncertainties relating to events or conditions that may cast significant doubt upon the entity's ability to continue as a going concern, the entity shall disclose those uncertainties. When an entity does not prepare financial statements on a going concern basis, it shall disclose that fact, together with the basis on which it prepared the financial statement and the reason why the entity is not regarded as a going concern. Another general feature is accrual basis of accounting. An entity shall prepare its financial statement except for cash flow information using the accrual basis of accounting. When the accrual basis of accounting is used, an entity recognizes items of assets, liabilities, equity, income, and expenses when they satisfy the definitions and recognition criteria for those elements of financial statements. Another general feature is materiality and aggregation. An entity shall present separately each material class of similar items. An entity shall present separately items of dissimilar nature or function unless they are immaterial. Financial statements result from processing large numbers of transactions or other events that are aggregated into classes according to their nature or function. The final stage in the process of aggregation and classification is the presentation of condensed and classified data which form line items in the financial statements. If a line item is not individually material, it is aggregated with other items, either in those statements or in the notes. Another general feature of a financial statement is offsetting. An entity shall not offset assets and liabilities or income and expenses unless required or permitted by an IFRS. An entity reports separately both assets and liabilities and income and expenses. However, measuring assets net of valuation allowance, for example, obsolescence allowance on inventories, and doubtful debt allowance on receivables is not offsetting. Examples of offsetting that are permitted by an IFRS are 1. Presenting gains and losses on the disposal of non-current assets on a net basis by offsetting the sales proceeds and the carrying amount of the non-current assets. 2. Presenting foreign exchange gains and losses on a net basis, and so on. There are many of them. Another general feature is frequency of reporting. An entity shall present a complete set of financial statements at least annually. When an entity changes the end of its reporting period and presents financial statements for a period longer or shorter than 1 year, an entity shall disclose, in addition to the period covered by the financial statement, the reason for using a longer or shorter period, and the fact that amounts presented in the financial statement are not entirely comparable. Another general feature is comparative information. Except when IFRS permits or requires otherwise, an entity shall disclose comparative information in respect of the previous period for all amounts reported in the current period's financial statements. An entity shall include comparative information for narrative and descriptive information when it is relevant to an understanding of the current period's financial statements. An entity disclosing comparative information shall present as a minimum 2 statements of financial position, 2 of each of the other statements and related notes. When an entity applies an accounting policy retrospectively, or makes a retrospective restatement of items in its financial statement, or when it reclassifies items in its financial statement, it shall present as a minimum 3 statements of financial position, 2 of each of the other statements and related notes. The final general feature is consistency of presentation. An entity shall retain the presentation and classification of items in the financial statements from one period to the next, unless it is apparent following a significant change in the nature of the entity's operations or a review of its financial statements that another presentation or classification would be more appropriate. And also, an IFRS requires a change in presentation. These are the general features of a financial statement. In the next video, we will look at the structure and content of a financial statement. Thank you very much. See you in the next video.